One question I have, is there a way to spot distribution? Okay, what is distribution? I don't really like to think in terms of accumulation and distribution these days because it implies that there are entities whose actions kind of control or shape the direction of the market. And while this might be true, especially in some very illiquid kind of low cap shitcoins or stocks, generally there are just too many participants in any given market to talk in terms of accumulation and distribution. Okay, distribution is just selling, right? So what are the signs of selling? Again, it comes down to liquidity. Where are their buyers, and are they getting taken out or consumed? And that's important because even if someone is selling a shitload of whatever it is you're trading, if there are still buyers at those prices, the market isn't moving. So if you're asking how to spot market tops, there are a few things to look for. And the first is for price to be relatively high. And this might seem kind of obvious, but I always see people fading breakouts down at the lows. So wait until price is relatively high, because at that point, buyers are more likely weak, and it's more likely you're up at levels where sellers are going to be interested. Okay, so you're looking for that imbalance. And I'll talk a bit more about what I mean when I say relatively high on the webinar on scale, but for now I think that will do. You're all kind of well aware of when price has been moving up for a while relative to historical price action and is starting to kind of hit significant levels or pockets of sell side liquidity. The second thing to look for is overextension. Buy is exhausting. And as I've explained, one sign of this is a parabolic leg, which gets filled in very quickly. So this is a distribution kind of schematic from the Wyckoff school of thought. And this parabolic leg I'm referring to it's referred to here as the buying climax, or BC. Okay, this move here, and the response, price filling in that inevitably illiquid leg, is referred to as the automatic reaction, or AR. Okay, you'll often get a kind of parabolic leg, and then price very quickly fills in that illiquid move. That's your automatic reaction. And if you talk to someone who's into Wyckoff, they'll tell you that the AR indicates the presence of supply, but that could also just be a lack of buyers. Okay, an absence of buy side liquidity. And of course, this is just a schematic. The structure, what you might call distribution, comes in all different shapes and sizes, but generally you'll get multiple tests of the highs, referred to here as ST, secondary tests. Okay, prices hit some significant sell side liquidity, and it's kind of contained between that level and this flag limit in here. So you'll often get multiple tests of the highs and failure to push higher. But what you're really looking for is this, the boundary of that range to start getting consumed, for price to push all the way to the edge of this level. Okay, that's your flag limit, and even to engulf it. And after having consumed the liquidity in there or engulfed that flag limit, to fail to move higher. In this example, price does push above the highs here, and they'd call that an upper test after distribution, or UTAD, but that doesn't always happen. And when it does, it essentially happens because all this ranging, these secondary tests here, it's not only consuming the buyers at this level, it's also eating up the sell side liquidity, which is kind of containing price there. And so what will often happen is price will push up above the highs. But as long as there's still a large chunk of whatever level you're referencing on the left, or even a fresh level just above, okay, price will respond. And now, where's the next buy side liquidity? Well, there's nothing down here because it's already been consumed. So that's when price will break down. And that's all distribution is. Buyers getting weak, and the presence of sellers, that imbalance. And I see it as my job to kind of assess that balance, because there's just no way of knowing what's going to happen. Instead of failing at the highs at that UTAD, price may have just carried on up, and then Wyckoff fans would label that reaccumulation. But it's all just liquidity, making an assessment about which side you think is weak, and then taking trades at opportune moments which offer you favorable risk to reward.
Okay, Swissy. This is a trade idea I saw you guys discussing in a Telegram group. Quite a clear kind of setup here. This is your FTR. Okay, this is the area from which price left with good momentum. It's well defined. It hasn't been tested yet. Again, a little bit like the USD CAD trade. Price is kind of compressing up here. Okay. There is a tiny bit of liquidity in here. Okay, this was untested. And you can see price does pause there. But as I say, relatively compressed. So it's a really nice trade idea. But the point I wanted to make about this is the price appears to kind of poke through the level, but as I've said before, it's really important that you go and mark out whatever low time frame structure is holding this liquidity pocket down, because very often price will poke through the level and respond off something you can't quite see on this time frame. So what I've done is just zoomed in on this area here. Okay, this is the area which is visible on the high time frames, and I've gone down to the 1 minute and just highlighted this tiny structure which this is reacting to. Okay, and you can see price never breaches that level. So it's a really nice little trick I'd recommend you use for stop placement. You know, if you're going to short this, your stop should be above the extreme of the level, not somewhere in the middle. Okay, it should be above the level, and preferably above whatever structure is holding this down in the lower time frames. Does that make sense? Because very often you'll get this price will poke through this high, and it will respond at the lower time frame level, which is holding this down.
This is Bitcoin. Nice trade idea here. You said your limit missed by a few dollars here, but you've got this relatively fresh or untested pocket of liquidity up here, which you've marked out, and a really nice move into the level. And note that although that looks quite impulsive, it's not unusual for the price to run like that when it's moving through an area like it's moving through on the left. So this is a test of that. That's 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 a test of that. And above that, you've got this gap or void in price. So this move is not unexpected, okay, because that area is totally compressed. And as a result, you get that illiquid move into the level, and then a quick response. And price ended up retracing this entire move. This is a daily chart of silver, and what you've done is just identified some market structure here, flag limit and flag in the yellow boxes, and the FTR structure in blue. So it seems like you've understood it quite well. But remember that these terms are just ways of conceptualizing how liquidity moves around the market. And so that should be the focus. And in this case, if we just take a look at the context, you can see that this is the area we're looking at. And it's not this high here, which is the flag limit. It's this pocket of liquidity all the way on the left. Okay. See that? That's what's limiting this flag, that structure on the left there. And you can see what's holding price up at the lows, that pocket of liquidity just there. So this is the flag, and those are the limits of the flag, okay, for the time being, that pocket of liquidity and that structure on the left, which I've marked out. And once it breaks through here, consolidates, okay, and then carries on up, fails to return. This here is your FTR, as is the structure below it. Okay, and you can see that when price returns to this area here, it gives a nice response. Okay, there's a pause in price before it left that consolidation there, which gives a nice bounce, and then the more kind of voluminous area down here, price also responds there. And now, where are your flag limits? Where are the areas where I would expect there to be enough liquidity to limit whatever structure is forming in here? Okay, well, on the bottom, it's broadly this structure here. Okay, it's already consumed whatever's in there, but there's quite likely some at the bottom. Okay, so you might consider price kind of trapped between this area and the FTR above price, which is this here. See how it broke this consolidation, retraced, and then broke down again. So there's an FTR above and below price, and this structure is kind of trapped between the two of them. So trapped between this liquidity here and the liquidity up at the top of this FTR there. Is that clear? And it will remain trapped between those two areas until one of those two FTR extremes breaks. With regards to building trust, you know, I can't stress how important it is to practice. Okay. For example, if the market is bullish, you know you should be buying pullbacks, but it's hard to buy pullbacks, okay? Because we forget our analysis when price is shitting itself. We become afraid, and our emotions start to kick in and take control. So in order to develop trust in the idea or belief in the idea that price will rally when it's you know, shitting down hard, that you know that we should be buying a pullback, you have to practice, and you have to practice a lot. You have to practice it thousands of times until your brain gets used to the idea that buying that pullback is okay, and that you know, not only is it okay, but it will make you money. You need to get to a point where you're no longer afraid. You're no longer afraid because you've been through these experiences before. You will have been through these experiences, you know, hundreds or even thousands of times, and built trust in the expectancy of whatever behavior price is demonstrating. So, you know, just like in any other endeavor, it's all a matter of training. This building trust. To become really good at executing consistently, yeah, you've just got to train yourself to trust in your analysis, and to become comfortable with trading something that might otherwise induce fear. And part of this is to you know, only trade price behaviors that are crystal clear to you, because when you start thinking and second guessing yourself, it's very difficult to execute, to pull the trigger. Okay, so you want to be taking setups which you've practiced taking many times, and setups which are simple and clear. Okay. And in the process of training or practice, you'll uncover more and more nuances, and that way you'll become proficient in trading specific price behaviors. So that's how you develop trust, just like mountain biking or some other dangerous sport. It's scary, but with practice it will become second nature. Okay, because just like mountain biking, you'll get to know every aspect of the route. But of course, fear is also ultimately rooted in loss. So the process of building trust is it's a combination of practice but also applying proper risk management. And by that, I mean only risking what you're comfortable with, and that's going to be unique for each of you. But the point I want to make is that thinking about winning and losing, and especially about winning and losing money, can interfere with your ability to execute trades and to manage them effectively. So, it's going to inspire lots of difficult emotions and irrational thoughts, thoughts that will cloud your view of the market, and which will encourage poor decision making. So, you already know this, but I just want to emphasize that making money or not losing money is simply a byproduct of an effective process, and so you need to focus on the task. And the best way to train yourself to focus on the task and not on your whether or not you're making money is to trade on demo or with very, very small position sizes. And I know it's difficult because you want to be in there making money, but if you're not profitable on demo, you're not going to be profitable in on a live account. And so to determine the amount, which for you is you're comfortable with, I think a good way, I mean, even if you're not going to do this, just go through the thought process, is to log onto your trading platform and intentionally lose 10 trades in a row. Okay, so you're throwing away 10 trades, and if you care about losing that money while you're practicing, that's still too much. Okay, so reduce your risk. If you're scared, you're trading too big. And if you just keep reducing your size until you find a size at which you're comfortable trading, that will go a really long way in eliminating fear from the trading process, and you'll start executing a lot more consistently because the consequences of losing will become insignificant. And what you don't want to be doing is trading with 2% when you're still losing a lot, because you're gonna you train this fear response. Okay, you'll train this. What happens is your body produces cortisol, which is a stress hormone, and adrenaline. And what you're doing when you're trading prematurely with too big a size is you're training that fear response. So reduce your risk. As for the second question, how do you recover from a losing streak? It's a good question, because it's going to happen, and it will always happen. You'll get really nasty losing streaks. And the first point, and you probably already know this, is that you need to focus on expectancy. because it doesn't matter whether or not the next trade or the next few trades are winners, okay, or even the next 10 trades. What matters is whether or not you're profitable over a series of 100 or 1,000 trades, okay. But obviously that's easier said than done. So that being said, when I have a losing streak, I also take some time off, okay, just to make sure it's not something to do with my psychological state at that moment, which is contributing to your losing streak. Okay, so you want to build trust in the process and have trust in expectancy, and part of that requires that you don't become extremely risk averse and trade too small. But sometimes it might be a good idea to just take some time to make sure that there's not something going on with you that means you're not executing like you might want to be, or taking trades that you wouldn't otherwise. So taking the break will give you some perspective. In fact, I'd recommend doing this regularly, whether you're winning or losing, making sure that you're taking at least a couple of days off a week, and that that taking time off might also prevent you from trying to make back your losses, which is probably one of the worst things you can do after a losing streak. Okay, worst thing you can do is try and make back the money you've lost, but it's a very real temptation, and it will lead you into a vicious cycle, which compulsive gamblers are all too familiar with, and that's risky trading behaviors like over trading or revenge trading are likely to lead to more losses, and therefore to evoke the same unpleasant emotions and unhelpful thoughts that led you to overtrade in the first place. Okay, so one practical thing you can do is just set aside a bit of money to recapitalize your account if you get into drawdown, and this will help alleviate the need to trade your balance back up, to trade it back up to what it was before the losing streak. And so just topping up your account if you get into some drawdown, you'll avoid trapping yourself in a vicious cycle of trying to win back the money you've lost. So that's something I do, and it really helps with taking your mind off the losses. Okay, so say I get 5 losers in a row, for example, and I'm risking 2%. My account's 10% down. I'll top my account up, okay, and that really helps with taking your mind off the loss. So those are my thoughts on that. Practice. Reduce your size. Find some way to focus your mind on process, on expectancy, and not on the next trade. Take time off and set aside some money to recapitalize your account when times are bad. All right. But honestly, there's no magic bullet for this. It can be a grueling process, and it will likely just take time for you to work through these issues and find what works for you. Why aren't the circled areas FTRs? Okay, this is the Ethereum Bitcoin chart from the last webinar. Price made a lower low, then retraced a bit, then made a second lower low. Okay, this is a good point, and there are a few different parts to this answer. The first thing to say is that yes, those areas you've circled are technically FTRs. Within each of these kind of larger structures, right, there are multiple FTRs. Okay, within the larger structure there are multiple FTRs, but it's important that you always reference the higher time frames first, and I'll cover this in more detail on the on the webinar on scale, but you've always got to be aware of context. In some situations, you could trade. Let's see, an FTR like that. Okay, you could take it short up here and have a good chance of running it down if price is kind of moving into an illiquid area, because you don't expect much support in that case. But I've got a chart here. In this case, you can see that the move up on the left wasn't particularly illiquid, and as a result, price is going to take its time on the move down here as it kind of works through or consumes the leftover liquidity at those levels on the left. So try not to kind of bank on the immediacy of a move. Make sure that you're aware of the rhythm in which price is moving. So, you know, if price is moving back through a highly illiquid move, then you can take trades off low time frame FTRs like the ones you marked, like this one in here, okay, or this one in here. If this here was illiquid, those would be more likely to hold. But otherwise, make sure you're checking the high time frames, because you can usually expect price to retrace to more significant sell side liquidity. So this is an H4 chart, just so you can, so it's clear what I'm saying. And you can see that, you know, the FTR you marked were, one was in here and one was in here somewhere, I think. And you can see that they don't even show up on this time frame. Anyway, the point is that if prices hit buy side liquidity on something like the 4-hour chart, okay, down at this low here, and down at this low here, you can expect it to retrace to sell side liquidity which appears on the same time frame. Okay, in this case, this nugget in here, and the structure up in here. So make sure that you're not jumping the gun, basically, unless price is moving into a highly illiquid leg in price. Expect FTRs to start forming on the higher time frames if it's bouncing from a level like this or a level like that. Okay, this is Bitcoin again. After resistance is broken, the first time back is in a short period of time to the FTR. Could that be a signal that sell side liquidity is strong? Also notice the length of the impulsive move length is shorter. Seems the strength isn't strong to the upside. More touches to the FTR within short amount of period here is a signal that sell side liquidity is strong. Relative strength on the sell side is strong, and this could be close to a local top considering area in the range. I really like this question because it displays a dynamic approach to price action. And you're right, you know, the fact that price is coming all the way into the, you know, into the far end of this buy side liquidity, it renders this FTR weak. And it's tested 3 times in quick succession here, which is not to say that price couldn't just carry on up for a long time, but what it does tell you is that this area is very unlikely to hold if price does come back to it after having picked up sellers up here. Okay, so it doesn't have a very good chance of holding. It reminds me of, somebody sent me this, I think from Twitter. It reminds me a little bit of this. And the question posed was, which low is the weakest? A, B, or C? And the answer is B is the weakest low. much like the previous chart, price has come all the way to the extreme of the FTR or whatever buy side liquidity this represented, and then as it moved out, it's come back and tested it. Okay, A is somewhere in the middle. Okay, it's reacted to the proximal boundary of the buy side liquidity, so there's probably still some orders in here, and it's come back and tested that level. C is the strongest. There are still fresh orders here, and this low hasn't even been tested as price moved out. Okay, so this is how I'm looking at levels when price comes back to them. I'm making an assessment of how strong I think they are based on how deep price went and how many times it's been tested.
So Bitcoin again on daily time frame. I like the way you've marked this out. This is a daily FTR. Within that, you've got residual buy side liquidity. Okay, that's your FTR. For price to remain bullish here, you really want to see that hold. Price breaks it here, retraces. It's up at this fresh sell side liquidity, which you're anticipating a top. Okay, looking to run price down through this illiquid move to the next area of significant structure. So question is, can we call this one our flag limit on the daily, and what exactly is a sign that buyers are drying out in this zone? For example, a lot of tests and weak reaction eventually, or failure to make a higher high. Yeah, you can call that a flag limit. You know, price is currently flagging out here. You might think of it as trapped between this area here and this area here. Okay, so those are your flag limits. Ideally, for a trade here, you want to see one of these two areas broken. Okay, the price to break that, retrace into whatever structure was left behind here, or okay, break that, form an FTR, carry on down, and then retrace into that. Or you'd want to see the area on the top get broken, the price to form an FTR, and then you can long that on a retrace. So this is your flag. Price is constrained between these two pockets of liquidity until one of these two areas breaks on the higher time frame. On the daily chart, you don't really have a trade. You know, what I'd like to see is for price to probe deep into this area. In that scenario, you can consider a trade either somewhere in here, depending on, you know, how this kind of develops, or even deeper up at the top here. The idea being that market structure is bearish. Okay, it's making lower lows, lower highs. If this gets you know, almost fully consumed, it's worth a shot. The short's worth a shot here. Okay, because you've got room for price to run. So yeah, you either want to see this get engulfed, or you want to see multiple tests for price to move to the extreme of this area. And then given the right setup, you can short that. Okay, gold trade idea. You've kind of planned out a trade plan from the daily down to the hourly. Yellow structure holding price down. Here's that daily structure. Okay, clearly a significant level and a good high time frame level around which to structure a trade. Down to the H4, FTR high low moves away with momentum. Plans to take a trade from the low time frame FTR that broke market structure. Let me just get the annotation tool up. Okay, so on the H4, you've got this fresh untested liquidity the area from which price broke out with good momentum. So good stuff here. That's exactly how I would be refining levels, zooming into the lower time frames to find those untested pockets of liquidity. And then on the H1, compression down into the level orange circles where liquidity has been taken in the consolidation. Therefore, price should move with ease back through. Also, you've got a small inefficiency above the consolidation, which should be filled back to the upper yellow level, which is the target. So here's the compression. That's a test of that. That's a test of that. You do actually still have some fresh liquidity in here, but this consumed whatever was in here. Okay, that's all compressed. And then you're right, above here, this is an illiquid move which should get filled in. Okay, so exactly what I want to see coming into a level, because that suggests to me that this broad kind of resistance area is washed out. There's unlikely to be much residual liquidity there, and so you've got exactly what you want: room for price to run here, and I like the target. Okay, untested pocket of liquidity up here at the high. So I know we've been over this, Alex, but all in all, what I would consider a perfect trade plan, and I think under any other circumstance, would have got a nice reaction from this yellow level down here. But unfortunately, you took the trade under quite extraordinary circumstances, and those are just kind of becoming clear now. And price just blasted through your level. And again, this was exactly the scenario I was talking about in the webinar a couple of weeks ago on approach. The market was in full-on panic mode here, largely as a result of that drop in the equity markets, meaning heavy selling and large liquidity providers withdrawing liquidity from the market. A lot like we saw in Bitcoin last week. And of course, usually the S&P is inversely correlated with gold, but in extreme circumstances, and this is what likely happened here. Institutions with leverage positions in the S&P, or other instruments would have dumped their positions in other markets, including gold, to cover those margin requirements. Anyway, what's important here is that, you don't really get any warning of this, but it's one of those situations where news or fundamental factors are compounded by inefficiencies in the market. So as well as all that selling, what you will have had here is liquidity being withdrawn from the market, resulting in otherwise solid levels fading. Does that make sense? And so I guess the takeaway is that it's important, if you're trading these markets, that you're really aware of the kind of conditions you're trading in, and an awareness of those conditions requires a familiarity with the market. Okay, because the books at the moment on the S&P, for example, are so thin that if you're trading the S&P or any correlated markets, you're probably taking on a lot more risk than you might think.
Okay. Regarding the second webinar, the move on the footprint chart, which I've got here, do the zeros on the left side mean that no market selling has occurred? Or does it mean that, it doesn't mean that zero limit orders on the sell side of that area. So the question is, do these zeros mean that there was no market selling there, or does it mean that there were no sell limits in that range of prices? And the zeros mean that no market selling occurred at these levels. Okay, so no one hit the bid, no one sold into the bid at these levels. And the numbers on the right represent market buying. And of course, to market buy, you need sell orders, sell limits. So these numbers on the right also represent the the number of contracts in sell limit orders which were consumed by buyers at those levels. And all that's happening here is that price is kind of gapping up, usually as a result of stops. The liquidity at multiple price points is getting bought up all at once. Okay, let's say here there's a $2 million stop. Okay, an order to execute $2 million at market. Once that gets executed, it will consume all the available liquidity on the sell side all in one go. So it gaps, and as a result, price will jump from here to here all in one go. And because that's happened all at once, there's just no time for sellers to hit the bid to sell into whatever bids might have come in here in the split second this happened. And quite often, you know, because this all happened so quickly, there won't even be any bids here. And so if you were to sell at this level, okay, if you were to market sell when price is here, it's quite likely that the books here haven't repopulated, and so the last buy limit is down here, okay? And so that's where your sell would be registered on the footprint chart. And as a result, these zeros would remain there. Anyway, I won't go into that in too much detail because I've got a whole webinar planned on the footprint, and there's a lot more to it. But is that clear for now? Okay. Ben's asking, how do you account for slippage on your risk? Well, if I'm trading on BitMEX or around major news events, I'll just risk slightly less. And it's worth being aware of the kinds of areas you're keeping a stop at. So in this case, I likely wouldn't have my stop above the 10K level, where I know there's an absence of liquidity and where a lot of other stops are also going to be resting. Okay, so you've usually got quite a good idea of when you know, the kinds of areas at which you're likely to get nasty slippage. So I just recommend being kind of cautious around those areas and making sure you're not you know, keeping your stops where you expect that influx of order flow. But unfortunately, you know, you can't totally account for slippage. It's one of those unknown variables. You just have to do the best you can to manage it and be sensible with your stops and sensible with your risk. On BitMEX, what I'll also do is I'll set my leverage so that if price runs very quickly through my stop, my position will be liquidated a few dollars past where I want it to get stopped out. So rather than get stopped out hundreds of dollars from where I intended to get stopped out, my position will just be liquidated more or less where my stop was. So yeah, I would recommend doing that. It will protect you against black swan events. Okay.
This CVD here, we can see lots of markets selling, but price showing us divergence and failed to go lower. Does it mean absorption, or what our thought or assumption should be? Yeah, this is a great example of delta divergence. Price failed to make a lower low, even though over the course of this whole area, there was more market selling than buying. Okay, to me that says that the limit order book here is strong on the bid side. Okay, because you've got more market selling than buying, and yet price isn't moving lower.
This is Ethereum USD on FTX, which is a relatively new exchange. And I see you've just been kind of tracking price here, marking out relevant structures. the first thing which I notice is that this here isn't technically an FTR. So you've marked out this structure here, but you can see this hasn't broken whatever liquidity in here on the lower time frames is holding price down. So you know, when that gets engulfed here and price retraces before carrying on up, this is the first structure which I would describe as an FTR. Okay, but as I say, the names aren't important. What's important is that you're identifying the presence and or absence of liquidity here, and you're right, there is a fresh pocket of liquidity down in here. Okay, which you can see how price up when it retraced, and again here price breaks out, it retraces that thin or illiquid move. Where to? Well, it stalled down here. Okay, the extreme of that FTR, after having kind of stalled at this right here, which is the area from which price left with good momentum. So it consumed the liquidity in there and then dropped through to the next fresh or untested liquidity down at the bottom there. And two really nice examples of compression here, by the way. Okay. Sorry for these markings, but you get the idea there. And you can see how quickly price moves through those areas. Okay. Expected bullish reaction, but failed to provide higher high. How do we anticipate this? Okay, well, you can never truly know whether or not a level is going to hold. As I say, it's all about playing the probabilities and taking trades with favorable risk to reward. But one kind of clue here that buys are weak is simply the length of time for which price sat on that level. Also note how the entire level got consumed there. So in this case, if price starts finding sellers up in here, it's reasonable to assume that this level here is going to break next time price comes back, because it's been totally consumed. One other thing to note is the high time frame structure here. As I mentioned, I'll come into this in more detail in the webinar and scale next week. But see how price is kind of trending down on the high time frames, right? Okay, it's breaking lows, and this is the section of price action you have annotated, and see how it's retraced that illiquid move, and it's now up at this area here, the area from which price left with good momentum. So, you know, it's up at the area from which price left this higher time frame FTR. So in this scenario, I'd be wary of looking for longs or expecting levels to hold anywhere up at the top of this section of price action. What I'd rather be doing is looking for clusters of buy side liquidity to start failing on the lower time frames, and then looking for shorts. Does that make sense? That when price is at a high time frame level, you can usually expect the higher time frame kind of trend to sort of take control, and for levels in the lower time frames to start failing. Because when you're up at a higher time frame level, the probabilities are quite high that, you know, buyers are starting to get weak there, and that price is coming into some more significant sellers. And indeed, price starts breaking down, and you just made a note of the FTRs there, and you know, look how well price responds to these little areas, the areas in which price leaves with good momentum. The areas from which price breaks out of those structures. Right, this is a recording of a trade I took on Euro GBP during the last mentorship, and I just thought I'd include it here so that you get to see what a trade looks like from start to finish. So you can see the high time frame context here. Price has broken these long-term highs. This is a daily chart, by the way. It's formed an FTR, okay, pushed up, retraced, and continuation. It's pushed up, and then it's broken back down through the low here, back down through that FTR. And so, given that we're into this relatively thin or illiquid leg, I'm now anticipating that price will find resistance somewhere up in this daily liquidity base. Okay, so that's the context here. So this is the daily level, and within that, you can see I've just marked out portion of the area from which price left with good momentum. Okay, and see, price appears to be kind of trending up here on the lower time frames, higher highs, higher lows. But in this case, I'm not afraid to fade that because the high time frame market structure is bearish, and in this case, price is simply kind of drawing back into this thin or illiquid move. So this blue box up here is the area I'm interested in trading at, and you've also got this nice kind of thin move up into the level here. Right, there's no basing, no significant basing anywhere in this leg. So it looks quite thin, and so I'm expecting that to get filled quite easily. And I just marked out this base down here. Although I expected this to move lower, that base was my first target. And at the time, it looked like a relatively good spot to take profit, as you can see the top portion of that level has already been tested twice, but the bulk of it remains quite fresh. So I'm just watching price as it kind of runs up into the level. And when it tags it, I just sell at market, and my stop goes above the liquidity base there. So I think I held this one overnight, which is fairly unusual for me, but I'd already taken risk off the table, so I was quite comfortable holding onto this one. And you can see that it kind of fucked about for a while, which is typical of the Asia session before finally breaking down. And there, I'm just moving my stop down above this low time frame structure. Okay, and that's just to lock in the majority of my profit, because the lower this gets, the higher the chances of it reversing on me. So risk reward is a movable feast. It's an evolving concept. Okay, I'm not leaving my stop all the way up here because I'm risking 5 or 6R. Then does that make sense? So what I'll usually do is track structure on the lower time frames, and as price approaches my target and the chances of it reversing become higher, I'm moving my stop down with price to lock in profit. In this case, just above that, there's the low that got broken. Price broke it, retraced, and then carried on down. So just above that low time FTR. I'll skip to the end here. And you see price eventually hits target for about 6R. Another trade off the top of an FTR here. Let's see. See, that's the last low before this high up here. Gets broken there. That's your retrace. Breaks the low. This is your FTR base. And that's the extreme of it. Which is good. I'm not sure where your target was, but you know, I would have expected this to move lower, to move all the way down here, given the relative vacuum in this area, and that, you know, it's engulfed this buy side liquidity here. So, you know, if I'd have taken this, I would have been stopped out, but my stop would have been moved down as price action progressed. So if I'd entered there with a stop there, at this point here, my stop would have been above there. Okay. So, you know, for me, my target would have been down here somewhere, but you're not taking a loss. So I'm not sure how you managed this, but that's how I would have gone about it. And that's the benefit of getting really tight entries. Okay. You've got plenty of room to manage and even mismanage trades and still come out with a profit.
Okay, this is a 30-minute chart of gold, and when price was up here, someone posted in the Telegram group asking if this were a potential false break setup, and I posted a chart highlighting these relatively equal lows, below which we know there's likely to be an inefficient run as a result of the stops resting down here. You've also got this fresh or untested liquidity, so it's a perfect false break setup. And the move down into the level is also ideal. It doesn't look particularly impulsive, given that this whole section of price action is totally compressed. Okay, but as you can see, price just blasted through this level. Okay, and the question I wanted to talk about was this one here. I'm thinking about the warning signs about gold that we should have looked into before thinking it was going to go up. What should we have checked that would have signaled that it would engulf that liquidity beforehand? So how can you have known that price would engulf this liquidity base beforehand? And I think I posted this in the group at the time, but the only reason this level got nuked was non-farm payroll, NFP. And as I've explained before, on big news events, liquidity providers pull liquidity from the market because news events give rise to the potential for volatility. So, you know, although news may be insignificant when it comes out, liquidity providers are prepared for volatility. Okay, so liquidity moves away from the market. So where we might normally expect, you know, maybe a little bit to be pulling down at these lows and some down here at the bottom of the space, maybe some here, maybe some here, maybe some here at the top. Okay. When there's news, the liquidity pooling in these areas gets pulled basically, and it starts pooling further away from the market. So maybe some down here, maybe some down here at these lows. Okay, this untested base. So it gets pulled from the areas in close proximity to the market and starts pooling further away because people expect volatility. They expect price to move further on news events. So you really have to pay attention to the economic calendar when you're trading FX or something like gold, because even if the news isn't significant, which in this case it was, price isn't going to behave as you might normally expect. Okay, if it weren't for the news here, this would have been a perfect setup, okay? And yeah, very likely you would have got a nice reaction from the space and a nice trade out of this. But in this case, the level gets broken with relative ease, and because there are still stops, of course, resting beneath these lows and no liquidity, you get this cascade. Price has to start reaching to find liquidity. Is that clear? So nothing really that would have signaled that this price level would get broken so easily. But apart from news, okay, you have to be aware of big news events when you're trading FX or something like gold.
This is UJM15, and it's a great trade idea. From the 26th of June, 1 on the left here. This was a local bottom. 2 was the first consolidation on the way down, just above this consolidation at 3, which is an FTR. Okay, this candle broke the low over here, and this was the consolidation before price broke this low. Okay, so that's your FTR. 4 shows a reaction to a level on the left, so somewhere on the left over here there's a high time frame level, and it engulfs the FTR at 3 and probes the liquidity up here at 2, and he's asking the level at 4 is tradable, correct? Yes, it is. It's a great trade idea. Price has engulfed this, so when I see that, I'm on the lookout for longs. Where are the buyers in the market, and where do you want to be a buyer? At the extremes, okay? And down here we've got a fresh level, okay? It's also worth noting that price has probed too. It's gone all the way to the edge of it, and it's chopped about quite a lot up here. So, you know, it's likely that the liquidity which came in up at this level and up at this level has already been consumed. So, if you take a trade down at this level, this is one of those times where I'd be looking to hold. Okay, because in here, this is all compressed, okay? It's gone all the way to the top of this liquidity, and up here, there's a void, okay? So this is your target up in here. And the way price moved into your level is it's really nice as well. Note how fast it is, but not impulsive. Okay, there's nothing on the left here which I would expect to provide too much resistance to the fact that it moves down quickly, especially considering you've got these lows here. There would have been stops here. That's not at all surprising. So this move isn't impulsive. It's what I like to see. It's thin, and note how quickly it retraces as a result. Okay. So yeah, great trade idea. I don't know if you actually took that, but I really like it. This is a nice pattern to watch out for. Okay. Engulfs the FTR, probes the second, and retraces to the extreme. Would be good if you could confirm, just so I have a clear definition. An FTR is a zone that was created after market structure is broken. The zone to buy in this FTR would be the last consolidation pre-breakout, or simply the low of the FTR, if that was where a lot of buying happened. Yeah, that's a fairly good definition. Last night I quickly drew up a diagram just so you've got a nice kind of visual. So price breaks this structure here. Okay, that's where you'd expect liquidity. It retraces or consolidates, and this structure can take on all different shapes and sizes. But what's important is that it breaks down. Okay, carries on down. Ideally past whatever liquidity was holding this structure up. Okay, So there'll be something off to the left here. Perhaps you can't see it on this time frame, but that's what price is responding to. So ideally, it's not just this low which you want to see broken, it's whatever liquidity is supporting this structure. Does that make sense? Because then you've got a trade, right? You've got room for price to move into. So that's your FTR, and within that structure, there are a few points at which I expect there to be liquidity kind of pooling. So imagine this is let's clear this up. Imagine this is a magnifying glass. So we're looking kind of close up on this section of price action over here, right? And wherever you get a pause in price or some consolidation on the lower time frames, and then price extends without coming back to test that base, I would expect there to be liquidity left over in those areas. But yeah, the main areas I look to trade at are the extremes, so all the way up at the top of the FTR, and this consolidation here, the area from which price broke out of the FTR.
So this is a chart, and this is just for the purposes of the group, the notes which I sent you. So the nature of the price action in yellow, this is what I referred to a minute ago, compression, which I'll cover in a couple of weeks. As I say, suggests to me that this whole area is weak. You can see that the blue flag limit there has been fully consumed. This whole structure here is the high time frame FTR, within which you've got these low time frame FTRs, low time frame consolidations, at which you can expect liquidity to be pooling. Okay. And I just noted that, yeah, as I explained, when price breaks down through this structure, to me that suggests that, although you're likely to get reactions at these areas, for me, shorts on a retrace look more attractive for swing trades because you've got more room to run price down. Okay. But yeah, you mark the levels perfectly here. And yeah, that's what played out. Both levels gave a really nice reaction. This went almost to the dollar, and then supported price when it dropped off dramatically like that. So is that clear when I say, although there's liquidity here and you can, there's evidence of that here, once price gets down there, shorts are beginning to look more attractive because as a result of this break in market structure, we can expect price to continue breaking lows, breaking areas of buy side liquidity, and for highs to hold. And so you can't expect a buy down here. What I mean is you don't want to hold on to a long from here past this high, whereas you can look to hold a short from up in here down past this low, okay? Because as a result of the market structure, which is bearish now, you can expect lows to carry on breaking. So there's more value in shorts here.
Okay, I'm watching gold on the 1 hour, and I'm seeing a violent move, then a flag limit and a flag. Do you see the same thing? This is just a question I got sent a few days ago, but I wanted to cover it because it's a really nice example of the kind of order flow dynamics I've been teaching over the past few weeks. So yeah, this is gold. There's your violent move. Okay, price engulfs this low, and it retraces to that untested pocket of sell-side liquidity up in there. And you'll note that this whole area is compressed. Okay, see how this was a test of this, and this was a test of this, and this was a test of this, and now price has kind of broken into that compressed area. And below that, you've also got this nice gap here. So that makes for a really nice target. So what I've done here is just narrow down or refine this area in here. Okay, you see that that's the area from which price broke out of that tiny consolidation. So I've just zoomed in and marked that out. And again, you've got two options here. The first is to short it as it comes into the level. Okay, and in this case, that's an option as the approach was really nice and kind of thin, right? But unfortunately, this was coming into Asia, and so I wouldn't have been taking a trade then. Not just because I don't trade that late, but because you often get this kind of price action, low volatility, sideways ranges. Anyway, the second option is to wait for that low time frame break in market structure, and in this case, you can see quite clearly that here's your flag limit. Okay, the area in price which was supporting this structure, and here's where it breaks. Price breaks down through this low, retraces, consolidates, and then carries on down. So this becomes your FTR, and when price comes back into that level, you sell it. And in this case, it retraced to the very extreme of that level, which is one of the areas at which we expect liquidity. Okay, before breaking down again, moving through that compression and into that gap in price I showed you on the H4.
Okay, before we enter a trade, what questions should we ask ourselves? Such as, where is liquidity? Has it been consumed? Where is price heading? And how do I expect it to move? Where can I get in? Yeah, these are all great questions to ask yourself, but ideally, you want to get to a point where you've practiced trading these structures and these order flow dynamics so much that you don't have to ask yourself these questions before you enter a trade. Okay. For me, if something sets up, I recognize it immediately, and I don't have to think about whether or not it's there's value in the trade or it's a good trade, because I've seen it play out so many times. So yeah, I can recognize kind of intuitively where there's likely to be liquidity pooling. You'll get to know when it's starting to look weak, when it's been consumed. And yeah, as I say, you'll become adept at quickly spotting, those areas where price has room to run, those illiquid moves in the chart. But it is, to ask yourself, how do I expect price to move is really valuable, because, once you've built up a model for price, you should be able to kind of have some expectation for how price should move through certain areas. For example, it should find support or resistance at previous areas of consolidation. It should move relatively swiftly through illiquid legs in price. And the reason why that understanding is important, and why it's important to kind of ask yourself that question or have it in the back of your head, in the back of your mind, is because if price isn't doing that, then it may be the case that your read on price is wrong. maybe there's something you've missed. Okay. But yeah, they're all great questions for now. But ideally you want to get past the point where trading is a mechanical process, and so you won't need a checklist like this. You'll come to the point where it's almost intuitive, almost a kind of muscle memory. Okay.
Okay. Questions about the first webinar. It's often said that triggered stops turn into market orders, but I never use stops as market orders. Rather, I set them as limit orders to avoid getting filled at a shitty price. Is this something we can neglect because so few people use stops in that way? Yes, most people use stop market orders, and there's a good reason for that. So a stop market order will immediately convert your stop into a market order, which will get you out at the next available price. Whereas a stop limit is just converted into a limit order. And of course, if price is running quickly, that limit order is very likely to go unfilled. So yeah, I'd really recommend using stop market orders rather than stop limits, because although you'll sometimes get slipped, the dangers of that risk are far outweighed, at least in my mind, by the dangers of not getting stopped when you want to get stopped. If you want out, there should be a good reason. So make sure you're out. Okay, you don't want to be left sitting in a long when some shit happens and price crashes 10, 20, 30%. Okay, in your example, you say that if a large market order pushes price up, buy limit orders generally don't have time to repopulate the book. But on higher time frames, they have plenty of time. How does this logic apply to a 4-hour, 1 day, or 1 week chart? Okay, good point. It's not really a timing issue. It's more that there is a lack of buying interest at those prices. So whatever the time frame, when there's an illiquid move relative to the scale on which you're viewing price, you need bids moving up with price for it to carry on up, right? And if there's no bid support, then price will drop. So this is just a Bitcoin chart. I think it's H3 or H4, and you can see that this move here got retraced very quickly, not because there wasn't enough time for bids to accumulate up at these levels, although time does play somewhat of a factor, but I'll talk a bit about that in the webinar on scale, but because the liquidity which you can see did move up with price on the lower time frames, came in to support price up there, it just wasn't enough to satisfy the kind of demand of sellers. Whereas here, whatever bids moves up with price and supported price at this level, those bids were enough to stop whatever sellers came in at this high from breaking down through these bids and filling in this weak leg in price. And what happens is that limit buyers sitting at whatever level this structure here is supported at, those limit buyers are absorbing sellers. So people are market selling into buy limit orders, which are kind of pooling at whatever level this is sitting on. Then when price hits a liquidity void in here and price starts moving quickly, some of those buy limits, their intention is to get filled, let's say at any price within this range, okay? And so they'll chase price. So if you watch the book, they'll be very rapidly moving up with price. And a lot of this is driven by algorithms, but let's say some of those buyers want to get filled at any price within that range, and so they chase. And it's only when price hits some significant sell side liquidity. Clear this up a bit. In here, it's only when price hits that sell side liquidity up there that price will slow down, and those bids that have moved up with price, they start getting filled. Okay, so now we've got bids accumulating here, and as price moves higher, some of those will move up with price, and it's those bids which are preventing price from dropping through this thin or weak leg in price. But of course, if price moves quickly out of this area, will do, because you've got stops triggering here. Price is running into this inefficient leg. Again, some of those buy limits will start chasing price. Okay, as price pops, some of them will move up with price. And those that don't want to chase will remain sitting at this level. So as price goes higher and higher, it gets weaker and weaker, because the buyers which have come in here, some of them are still sitting down there. Some of them are now up in here at this level before the pop. And then even fewer have chased price up to these levels. Okay, so as price gets higher, it gets weaker, because everyone has different parameters, and so not all bids are willing to chase. Does that make sense? I hope that explains why liquidity will be resting here in this structure, and not at the kind of SR which some people might have marked out here. These highs, okay, it's not at the SR, it's in this structure here. As price stalls at the supply which is present at that level, bids are kind of populating this area, and when it pops through the highs, some of those will remain sitting at that level. Although, of course, they do happen to coincide with the SR in this case. So virtually freshly created liquidity pockets never withdraw. Once they form, they sit there until they are consumed. Some of them do, yeah. Especially in crypto markets, the limit order books are relatively static compared to other markets. So yeah, generally you will have liquidity which just kind of sits at those levels. Okay, the Aussie JPY flash crash you showed, I'd be curious to know what time frame this is, because since price eventually comes back down to the lowest point of that crash, wouldn't that disprove the assumption of poor liquidity in the area above the red line? I guess I'm meaning something similar like the person that asked in the chat if it's indicative of a trend. Okay, I've got the chart here. As far as I can remember, I just drew a red line at these lows somewhere. But I'm not quite sure what you mean here. I'm not sure what you mean when you say that the fact price revisited those lows disproves the assumption of poor liquidity. I mean, as far as subsequent price action goes, you can basically kind of ignore, you can basically ignore this wick because it's somewhat of an anomaly. The only reason price traded at these levels was because there was no liquidity in the market at the time those stops were triggered, because it was a Japanese bank holiday, and whenever it was, Christmas or New Year's. Euro GBP weekly. I see some people looking for longs on Euro GBP on mid time frame, like 4 hour, but doesn't it make more sense to wait and look for shorts up here? And I agree with you here. If you look down on the 4 hour chart, the uptrend is quite clear, but there's a lot more value to be had in watching this weekly level and waiting for structure to start breaking down on the daily and then on the 4 hour, and to start looking for shorts, okay, when we're up in a weekly level like this. So yeah, I'll be looking for price to come up in here somewhere, and I'll be watching the daily chart, or maybe even the 4 hour for what I always look for, which is buys to start getting taken out. And, you know, as opposed to looking for longs on the H4, where you've got, you know, you're trading right into weekly resistance. There's just a lot more value in looking for shorts here. This is quite thin. Okay, so if price starts taking out buys here, that's a nice target. Okay, high, low. It's broken the high. But looking for longs on the H4 here is like I discussed last week. It's banking on the immediacy of a move. Okay, people, you know, it's broken out. People expect it to just do that. In fact, what will likely happen is it will retrace down here. Okay, so that's the trade I'm looking for. So I mentioned the flag limit. This is your flag limit, the area which is clearly holding price up. Okay, breaks there, fails to return. I'm looking for a short at the top of the FTR. This is gold on the 1 minute. Okay, and I was just saying that, you know, none of this up move is unexpected. There's a void here to fill. This move up doesn't represent buying. I expect this to get filled in. The bias is still short because the flag limit here has been broken, and we've got a bearish FTR. And the trade idea, broader trade idea, was this: to short from this FTR and try and run it down to the buy side liquidity here. You know, same idea as Eurahim, that, you know, this has been engulfed or spiked there, and we've got a void. So this is a nice target on the higher time frames. So I've got, you know, I've honed in on the area I want to take a trade at, top of this FTR, and I've got a higher time frame target and also an intermediate target, which I think I'll mark out in a second. And at this point, I'm just watching price on the lower time frames. Okay, just marking out the idea there. Just demonstrating the engulf. And this is the intermediate target. Okay, you'll see why in a sec. So this is the high before the low. It broke here. This is your FTR. It's been tested once, but this isn't a bad place to target for first profit. So I'm quite liking this move into the level. It's at the moment it looks you know, a little thin. There's no real basing here. You know, what I wouldn't want to see is this. Okay, I like that it's just kind of run up here quite kind of thin. There we go. I'm in. Stop loss above the FTR. I can't remember what happens here. I think it's quite a nice reaction. Let's see. I cut this here purely because the move into it was so thin, and when you get a move in which is thin like that, you'll likely get a move out which is thin and fast. So if it moves into support from relatively far away like this, that is you know, you want to get out there, because it's very likely that you'll get a retrace, and even if you're still confident in the short, you can get in higher up. Okay, so I cut that there because the move into it was thin. If it had you know, done something more like that, I would be more inclined to move my stop here or hold on to it for it, anticipating that this will fail because it's already been tested once. Right. What's your opinion on a non-standard time frame? For example, 10 minutes, 2 hour, 3 hour, 10 hour, 2 day, etc.
Time frame isn't important to me, only in as much as it's useful in assessing the significance of structures. It's something we'll talk about in the webinar on scale. But time frame is just a zooming function of the same data. It's unimportant to me. What's important is finding areas of liquidity and illiquidity, and those are apparent on every time frame. The time frame you use just depends on to what extent you want to refine those levels. So it really doesn't matter what time frame you use. You could use a 27-minute, 92, 2.5. It doesn't matter. Okay, you've identified a flag limit which is holding price up and was consumed. An FTR which was formed when that level got broken. And you're taking a trade on the retest of the level which broke through that flag limit with a take profit at an FTR near the bottom of the chart. And the approach is to your liking. So before I go into the questions, I'll just have a look at the chart. So that's the flag limit which was holding this structure up. It breaks, and you get a kind of immediate retest here, which only manifests as a wick on this time frame. And that immediate retest is often a trade I'll take if you've got a particularly illiquid leg below price. So in this case, you've got some fresh liquidity there, so I probably wouldn't have taken that. I would want to see this whole area get kind of washed out first. But let's say this illiquid leg was a lot longer. Okay, it had room for price to run. That immediate retest, that wick up to this untested liquidity after it's broken down through this flag limit, is often a trade I'll take with a stop above that liquidity. But in this case, you're correct to wait, I think, for this high time frame kind of rounded retest here. And you're right that price is now, when it comes back up and tests this here, it's cleared out this liquidity. Okay, it's gone all the way to the extreme, and it spent some time kind of fucking around down here. So that suggests to me that all of the liquidity in this general support area has been washed out. So you've got room for price to run down to, I guess, well, the next area of fresh liquidity, which you can't really see on this chart. Yeah, it's also worth noting that the approach is ideal here. It's an illiquid move, which is not impulsive, because the way in which price moved out of this area was also illiquid. Okay, so this illiquid move is expected. It's not impulsive because the way in which price moved out here was also illiquid, and so we can expect price to move through that with relative ease. Okay, so the approach is ideal. Not necessarily indicative of significant buying, even though it might have looked quite strong at the time. And yeah, it's really great that you're starting to internalize that kind of truth, I guess, because a lot of people take a long time to get to grips with that. And I know it's scary when price looks quote unquote bullish, but yeah, I hope you're all starting to get used to the fact that, as I explained, when price looks most bullish, it's often at its most bearish as a result of the fact that it's illiquid. Okay, I know you're not a fan of indicators, and liquidity dynamics is where it's at, but what do you think about using it for Confluence? And I already kind of answered this on Twitter, but just for the sake of the others, it's an interesting question. I don't use any indicators myself, but I'm not totally averse to them. It really all depends on what you're using and how you're using it. So I'd never recommend trading with indicators alone. but in combination with price action, they can be quite useful for kind of filtering trades. So, for example, when the RSI is oversold on whatever time frame, price is likely relatively low. Okay, same with fib levels. Does that make sense? When price is retraced 68 or 72 or whatever it is percent of a move, it's more likely that price is starting to get weak. Okay, so they can be good filters for trades, especially something like ATR. For example, you might have a rule that you only trade when prices retrace more than 68% of a move, or the RSI is oversold, or prices past its daily ATR. So yeah, they can be good filters, but just make sure that if you're using indicators, you've got a consistent process or set of rules for when you use them and what exactly you use them for, and that you're not just kind of taking trades based on the indicators alone, that your main idea is derived from price action. So this is a great trade idea on cable, kind of flag limit setup. And if I go to I've just got a chart of the H4 here. Okay, that's the area we're looking at, and you can see that price is at the top of this range, and it's just spiked this high here. So it's a good place to be on the lookout for shorts. Okay, and if we go down to the M5, you can see that that's the flag limit. Okay, the bottom of that little consolidation or base there. And you can see that it looks really weak, having already been engulfed on the first test. So what have we got? Price rallies, responds up here, untested liquidity, before just ranging or consolidating here for a while, and then finally breaking down. Okay, finally breaking down, moves quickly through this gap. So once that breakdown occurs, this whole structure becomes your FTR. Okay, broken the low there, it's retraced, consolidated, and then it breaks down there. Okay, so that whole structure is technically your FTR, and this is the area from which price left with good momentum. Okay, that's the area from which price broke out of that FTR. So it's a really good place to look to go short, and as price approaches the level, note how it's spiking down here. Okay, it's consuming the buyers which it picked up down here. Okay, sorry, extend that. Okay, picked up buys there. They're beginning to move up with price, but each time price moves up, it pulls back and it consumes those buys, effectively clearing the way for price to drop once it hits this fresh liquidity. Can you see that how it's just kind of compressing up into this level, and as a result, it has no trouble dropping through there once sellers start coming in. So yeah, a perfect trade setup really. But while I'm on this, I just want to point out something on the M1 just in here. Okay, so if I zoom into the M1, this is the range I just highlighted, and you can see where price found resistance That was never tested there. But as I explained in the webinar on Scale, if you weren't confident shorting that for whatever reason, then you can just wait and get in once price starts breaking down on the lower time frame. So there's actually a really nice full spake setup here as well, but I'll come onto that in a couple of weeks. What I want you to pay attention to is this structure up here, because it takes almost exactly the same form as your setup on the higher time frames, and that's what I mean when I talk about price being fractal. It's the same structure, illiquid move into the level. There's your flag limit, flags out on top of it, and once that breaks down here, you can get in on a retrace to the last untested liquidity, the area from which price broke out of this tiny range of consolidation. Okay, does that make sense? And then you can run that to the higher time frame target. One other thing to note here is that although on the M5 or whatever time frame that was, the M15, this area looks relatively compressed. Even on this tiny time frame, you can see that there's still untested liquidity in here. Okay, in here, down in here. See that? Which needs to be consumed, and which you can see price responds at before breaking down. So our expectation is that although there are still tiny pockets of liquidity here, they will very likely fail, because, just like I explained in the webinar on Scale, we're also breaking down on the higher time frames. Okay, so you can think of higher time frame sellers as being kind of in control. Anyway, just another observation there. It's important, even when price looks compressed on whatever time frame, to pay attention to these little nuggets of liquidity which went untested, because price will respond there. And it kind of pays to pay attention to these areas, because they might influence how you decide to manage the trade. Right? This is another trade idea, this time on Euro JPY. And the idea here is, I guess, to short this, the area from which price broke out of that FTR. So it makes sense, and you're looking to run price through this relatively inefficient move to the next kind of large build of volume down here. And this is what happened next. So you can see that the entry was perfect, but the target was a little off. I think price stalled down here. So yeah, I hope you managed the trade. If your stop's up here, once price breaks down like this and starts eating into this area here and compressing, okay, I'd be wary of a move like this. Okay, price can quite easily kind of rip back up through this whole area. So yeah, be moving my stop down to there. And again, if you split your positions, it's a good idea to take partial profits at areas like this where price could potentially reverse. And of course, the chances of price reversing are higher, given that the move down into the level is so illiquid. So, just like you want to see this when you're entering a trade, be careful when you see this when you're in a trade in the opposite direction. Okay, every time price moves down like this, it rips back up and fills in that move. But yeah, a good trade idea and a nice read on price.
The point I want to make about this is, you might think, well, this is the FTR, okay? It's what broke this high. Is this not what we want to see for price to remain bullish? Okay, should I not be looking here to take a trade rather than here? And one little nuance, which I'll just explain, is that you know, this is, I don't know what time frame this chart's on, but let's say this is an hourly chart. Okay, this consolidation here will be visible on the daily, let's say, and this won't. But what I'm always looking for, if I've got a daily level like that, is I'm looking down on the lower time frames to see what is holding up that level. Okay, and I'll include that flag limit in the level. And when I say take trades at the extremes, that's the extreme. Okay. So I think of it as being kind of attached to the level. This is the higher time frame level, but if you look down on the lower time frames, this is clearly what this level is feeding off. Okay, so this is where the orders are, and it is of course an FTR in its own right. Okay, it broke that. So just a nuance there. If you're marking out high time frame levels, go down onto the lower time frames and just see, is it feeding off a lower time frame level? And if that level is quite tight like this one, just include that in your level, and either have your stop beyond that, or it's also a great place to look for trades.
So I was looking at Bitcoin this morning, comparing low time FTRs to the heat map and book map, and you just marked out on a candlestick chart where there was some significant liquidity on the books. My question is, 4 million on the book doesn't really seem like a lot of liquidity. For example, there's 30 million currently on the book at 10.3. Is there any kind of hidden liquidity that one could anticipate at these levels? Perhaps hidden orders or algorithms that would start buying at these levels? I appreciate this may be conjecture, but just wondering what your thoughts are on this. And again, I answer this in an email, but just for the purposes of the group, I'll go over it again. So these are the levels you marked. Kind of low time frame FTRs, areas at which there's likely some residual liquidity as price ran up. Okay, you can see they were untested. 9925 and 10.4, something like that. And we've got bookmap here, and you can see down at 993 and at 10.4. These are the areas at which liquidity is pooling. And again, up at 10.3 and 10.4, which, as you'll see, 10.3 and 10.4, the very extreme of this area here, okay, this consolidation from which price broke out of this FTR, and up at 10.4, which is in here. And that's where price topped out. And I like that you're really looking into this to kind of verify what I'm teaching you here. Is I don't want to I don't want you to just take it for granted. And yeah, this is a really nice illustration of the fact that liquidity tends to pool at these areas. But you're right that 4 million, it's not that much liquidity, and you're also correct in thinking that heat maps like that are somewhat limited in that, as I explained, although cryptocurrency markets have relatively kind of static or stable order book compared to other more sophisticated markets, just meaning that there's a fair amount of liquidity just kind of sitting in the books all day. The majority of liquidity is latent, and we'll come onto this in more detail in the webinar on scale again, but this just means that it's somewhat hidden. Basically, large players don't want to advertise their intentions, and so they'll either hide their orders, which is somewhat costly and less common, or they'll filter their orders in and out of the market split seconds before a level's hit, mainly using algorithms. And it becomes quite apparent if you watch the order book on an exchange like BitMEX. You'll see that when price comes into a level, the order book will suddenly populate with liquidity. Okay. But yeah, a nice illustration of the fact that liquidity tends to pull at these areas, the area from which price left with good momentum, and the extreme here. Okay, this is a chart one of you brought to my attention. It's a chart of oil, I think, on the M15, and a great example of a false break setup here. So, okay, these were the highs, okay, 3, 4 highs above which there are going to be stops. An illiquid move through the level, okay, into this fresh liquidity up here. If you go down to the 5 minute, you can refine this even further. And then the response is entirely as you'd expect given the move up, okay, a very quick move back below the highs. And into this untested liquidity. Okay, so it's also it's a nice illustration of how when price is ranging like this, you should be conservative or realistic with your targets. You should generally expect for the range to continue. Okay, especially if there's quite clear untested liquidity like this. So in this case, if you'd taken the false break setup, that would have been my target, because there's fresh liquidity there, and you can see price responds, moves deeper into this liquidity pocket. This has been tested now, so when price responds up here, it moves down to this, relatively fresh liquidity. Okay. So this is how price moves in a range. It's bouncing from liquidity to liquidity, and when it's ranging, you should expect that to continue until all of the liquidity is exhausted. And we've got a similar situation on Bitcoin at the moment. I think I've got a chart here from yesterday. I see some people expecting this to just break down here, but the reason I expect it to continue ranging for a while longer is that there's quite clearly still liquidity down here at the range lows. There's a pocket in there which is visible on the lower time frames, and quite clearly some in here which is untested. I'd also expect some down in here, and again, whatever this low is kind of responding to way off on the left, perhaps there's also still some liquidity down there, and there's the potential for a kind of false break. Okay, so yeah, I guess the point is be realistic with your expectations. It's really important that you don't ignore very clear pockets of liquidity, because more often than not, price is going to respond there. And so it's really important you just make a note of them, if only for trade management or targets. Okay.
I want to comment on, feeling stupid, missing out on moves, because it's a mindset that you want to avoid. And a good way of thinking about this is, to me, the size of the move doesn't matter. It doesn't matter that this was a massive move. What matters is whether or not you get a setup or set of entries with a stop loss and take profit that fits your criteria or parameters for a trade, and parameters which if you stick to will from what you'll profit from over the long run. Okay, so if those things don't set up for you, then it doesn't matter how big the size of the move is. I'm not interested in it, because I don't have experience in setups that I haven't experienced. Does that make sense? So for me to take something, I want to see something that I've seen 1,000 times and know that if I trade that, it is profitable. So that's the first thing. The second is that the size of the move doesn't matter, because you can, someone could have bought this with a $200 stop loss and rode it all the way up, and they would make the same as if I'd bought this with a $10 stop loss and taken profit here. Okay, so I'd try and get out of the kind of mindset that you're missing out if you're not in on a big move, because size of the move doesn't matter. What matters is trading structures which you recognize and which you know are profitable over the long term, and trading with some precision so that you can make the same amount on a tiny move as you can on a big move like this.
Right. This is, I believe, Algo Bitcoin on the M15, and you said you entered down here around 3,100, somewhere in the bottom of this range, but got stopped out just a few days ago. And I like the levels you've got marked out here, and I think this is an excellent trade idea. So I've just got a couple of notes, some of which I sent you, mostly regarding trade management. So first I'll just go through how I'd have marked this out on a clean chart. All right, and as always, I'm keeping track of these liquidity bases as price moves up. Okay, specifically the bottom here, this one here, this one here. Okay, so I'd be keeping track of those as price moves up, and then when those start breaking, that's when you're looking for shorts. And so this is an FTR, okay, because it broke this low, retraced, and then it carried on down. And within this FTR, there are a couple points at which you'd expect liquidity up at the top here, and this the area from which price left with good momentum. And the same thing down here, price breaks down through this FTR, okay, retraces, and then carries on down past this local low. And the same thing again, price spikes into this liquidity base, retraces, and then breaks down. Okay, so as it's retracing here, price is hitting sellers, and then as it starts breaking down, it's kind of leaving behind pockets of sell side liquidity in these areas. Okay, the areas which price consolidated, and when you get the breakout of these areas, some sellers just aren't willing to chase, and so there'll be sell limits kind of backed up in these areas of consolidation, and you can see how price responds there. Specifically, there's fresh liquidity up at the top of this FTR. So although it's quite obvious in hindsight, your target was up here, I think. Although it's obvious in hindsight, I'd be looking to take at least some off at the top of this FTR, especially given that your target, it's not all that far away. Okay, and if I didn't take profit there and price started kind of reversing on me, in this case, I certainly wouldn't be leaving my stop down here. Although it's the initial stop placement is good. The reason being that this whole area now has been tested multiple times, and while price was ranging here, for however many hours. It was kind of consuming the liquidity at that level. Okay. So if it comes down there again, as you can see, it is very likely to push past these lows now, and once it starts breaking down, you're going to get a stop cascade here, because you've got all these kind of untapped lows just lined up. These stacked lows, each of which is going to have stops resting just underneath, and of course below that you've got this gap. So yeah, if I hadn't taken profit up at this fresh liquidity, okay, I'd probably moving my stop up underneath this low, because if price is to remain bullish here, you want these pockets of buy side liquidity, which price leaves behind as it moves up, to hold, just like up here. Okay, once this breaks, that's going down, and it's the same dynamic here. So you want this to hold. So I'd be moving my stop up underneath there. So yeah, I like the idea here. I'd just be more conservative with your target and make sure you're managing the trade. So move your stop up, or alternatively, you can get out once that breaks and price retraces. Okay. But I certainly wouldn't be waiting to get stopped out on this, because it's kind of an unnecessary loss, and you're given plenty of warning here.
So this is the 3K low. It's found buyers and or sellers have exhausted. It breaks market structure here. Okay, that's your momentum. And so even though this leg is illiquid, okay, I'm expecting for this flag limit here to hold, because we've just broken out. We've just broken out from the lows, and you can expect for buyers to be strong and sellers weak. And yeah, Bitcoin again from last year. Price breaks out from this bottoming structure. Thin or illiquid move. There's your flag limit. But you know, I'm expecting this flag limit to hold. These are great areas from which to look for continuation. Again, it's about context. In this case, the momentum's fresh. Okay, when price is starting to look exhausted, that's when we're looking for these flag limits to start failing. Up in here, for example. So I think this is a XRP Bitcoin chart. Price reaches out for the flag limit more than it does to the other side. So I would assume that significant amounts of sell volume have been consumed already. The fact that price is making higher lows speaks in favor of a long entry around the blue box. First, just a note about your levels at the top here. But again, make sure you're marking out whatever structure off to the left here, this high is kind of feeding off. Okay, because it's that structure and not this high which is limiting this flag. And it's worth being quite precise with the way you mark these out. So let's say, you know, this area in here, I'd be quite precise with the way you mark that out. Okay. So, you know, make note of the wicks. As for the question, it's a good point that price appears to be kind of draining whatever liquidity is holding price down in that flag limit. So reaching, as you say, for the top side rather than the lows. But there are 2 points here. The first is that momentum is clearly down, and in this situation, those pockets of liquidity, those flag limits, tend to be quite strong, and they usually make for really good areas from which to look for continuation in the direction of the momentum. got a chart here just so I can see what's going on. And the other point is that if you look on the lower time frames here, one thing to note just how nice this flag limit is. Anyway, if you look on the lower time frames, you'll see that price is quite kind of compressed. The manner in which it's moving up into that flag limit is effectively draining the liquidity at each of those higher lows, okay? And that makes it weak.
Just a quick note on the price action here. Number one, a thin or illiquid move. Number two, price briefly pauses, consolidates before kind of ranging, consolidating, flagging out underneath this structure. Okay, that's your flag limit. Price flags out underneath that structure. As price flags out, consolidates here, it is consuming all of the available sell side liquidity on the top side of this range. So that's compression. When price breaks down past this low, you get another thin or illiquid move, in large part as a result of concentrated stops, which you often get underneath a low like this. And then the same thing again, just to demonstrate that price is fractal. If I go to an even lower time frame chart, what I'm looking at is this area here. That's your momentum move. There's your flag limit. Okay, the structure off which this kind of broader range is feeding. As price consolidates here, it's consuming the liquidity at this level. Okay, so all of this price action on the top side here represents the consumption of liquidity. That's compression, and you get a thin or illiquid move down in here as price breaks those lows, and as a result price quickly reverses, and it doesn't have trouble moving through the area because that move down was illiquid. Just like on the on this chart here, once price moves back into this area, it has no trouble moving through it. And as a result of the compression on the top side of this range or consolidation, price also moves quickly through that area, all the way up to the next fresh or untested pocket of liquidity, which is at the top side of this flag limit here. So, you know, the same kind of dynamics play out time and time again across all time frames. Okay. Yeah, so I really like the way you've marked the levels here. This is an FTR, as you say, on the medium, on the 4 hour. Okay, it wasn't apparent on the daily chart. Is it our invalidation level for this FTR? For me, given that this pocket of liquidity was fresh, I don't expect price to be breaking this high. But of course, it all kind of depends on what you're comfortable with. For some people, keeping a stop that tight isn't conducive to their kind of personal psychology. For some people, keeping above the high might be preferable. And that's when, you know, getting to know yourself as a trader comes into it. Over time, you'll know whether or not keeping a stop tight above this high is the right choice for you, because even though it might be, you know, the higher expectancy choice, reducing your win rate for some might be kind of disadvantageous because it throws their psychology off in some way. So I'd keep it above there, but others might want to keep it above their high. It's all about getting to know yourself in relation to the market. Does that make sense? Yeah, this is a big trade. My stop was tighter than this actually. On the false break, my stop was above here. But yeah, the same trade on XRP I took. And I'll come on to false breaks in a few weeks. The majority of what I trade revolves around this kind of structure. Anyway, what have we got here? Price moved away from our FTR zone, hit our residual sell liquidity on the top of FTR structure and dumped through all liquidity till it hit daily structure with buy liquidity in there. And we have now our new FTR. Yeah, that's perfect. Price broke this low, retraced, and then carried on breaking down. And you're right, there's likely still residual sell side liquidity up in here. Similar to the Ethereum chart, whether or not it has the legs to get up there is a different matter. Also, market structure on a daily time frame is still bullish. How should we think about opening shorts? Shouldn't we buy daily structure in the first place? I debate whether or not market structure is bullish on a daily here. If we go back to your daily chart here, this is breaking down, lows are getting broken, and highs are holding. Okay, so my assumption now is that that trend will continue until I see some evidence to the contrary, which, you know, as I say, it's not to say you can't buy structures like this, because they will give a reaction. You just have to manage your expectations. Okay, you can't expect for price to push past this high. Not to say it won't, but you know, that's in my experience, that's the best way to go about it. So FTR zones on an even lower time frame. Invalidation level for FTR, which one? Okay, low, high, breaks down there. So the invalidation level is above the FTR. Low, high, price carries on breaking down. Invalidation level above the FTR. I mean, if you wanted to short it, okay, you can take a trade at the area from which price broke out of the FTR. Often I'll take that with a stop above that low time frame structure. But if you were shorting at the top, I'd be keeping my stop above the high there. But you know, it all depends on context. Sometimes, if there's another structure in very close proximity, like this one here, I'll just tuck my stop above that because it's not really affecting the risk reward too much, and it gives you a slight kind of buffer. Okay, and this is another good example of how the higher time frames take priority. Okay, because although you've got low time frame bearish FTRs forming in here, price has hit daily liquidity here, and so you can expect a deeper retrace. Okay, so when price hits daily liquidity, it will blast through low time frame structures like this until it hits some more substantial liquidity, areas of liquidity which are visible on the higher time frames.
What have we got here? All right. So I didn't take this trade, but thought I'd just run through the price action on cable last week here. because it was quite a beautiful example of the kinds of price action I'm looking for. This gap on the right here was on the news that Parliament was going to ask the Queen to suspend Parliament. Okay, so increasing the likelihood of a no-deal Brexit. And this is pound dollar, and I'm just kind of running through my thoughts on price action here retrospectively. So no trade, but I thought you'd be interested in just seeing how I kind of would interpret this series of price. A spike into a pocket of liquidity, very quickly filled, and engulf this nearest buy side liquidity. It's come all the way to the bottom of that. Okay, so liquidity there has been consumed. Okay, so looking for a short somewhere on retrace. There's nowhere particularly clear in here. Okay, so it's the kind of area I'd be looking for price action, and you see a low time frame flag limit form here. It's quite clearly holding this structure up. This must have been Asia here. A sloppy price action, and it's consumed or engulfed there. That's the retrace. Breaks the low. Okay, so this here is kind of confirmed as an FTR. And pocket of liquidity at the top, enter at the extreme.
Okay, Bitcoin here. Got a question about this on the next slide. I have two questions regarding this scenario. When should we pay attention to these moves? Whenever we have a violent move up, down, followed by price flagging out? And is the 1 minute time frame flag limit correctly marked? Okay. So I've just drawn this out again. That's the same level there. It's not visible on the hourly or the M15, whatever this is, but that's the liquidity there, and you've got it marked out correctly. And it's a good question and a good reminder that when price is moving with good momentum, these tiny pockets of liquidity can be really, really great places to look for trades. And this is the 1 minute. And while we're in here, I was actually watching this area to go short when we were pulling back there, but you'll notice that price never quite reached it here. So you track the liquidity. Okay, be aware of these pockets are, and then having noticed that price hasn't tapped into that, there's still liquidity resting there. So next time price comes back, that's fresh liquidity. And so if price is weak, you can look to short that next time price returns. And in this case, you get a really nice move into the level. And I'm not expecting any significant buying here because you can't see it here, but on the left, you've just got a gap in price, basically a vacuum, an illiquid move. And so we expect price to just trend down through this area. So yeah, look at these tiny pockets of liquidity when at areas in which you're not expecting any significant opposing order flow. Okay, so price is into a gap. I'm not expecting many buys to be kind of jumping in here. You're likely going to get a good reaction from them when you get an illiquid move into the level. And they tend to be more responsive when price is moving with good momentum like it was in this candle. But yeah, it's a kind of similar example to one I've showed you before, where price, you get this impulse move and price ranges out. Whenever you get a range like that, I'm looking down on the lower time frames to see, you know, what's holding it down there. Is there still fresh liquidity there? Because that's what's constraining this range. Price is trapped between that and whatever tiny pocket of liquidity is holding that up here. So you want to mark those out because that's the extreme. And yeah, as I've said, the primary place to seek opportunity is on interaction with the extremes. Identify what's constraining price, what's price trapped between here and whatever on the left is holding this up here, and then you you trade the extremes given the right approach until price breaks out of the area. Okay. If prices are going to carry on down, you really want this area to hold, okay, because it's the last kind of voluminous area before this illiquid move. So once price starts breaking into that area, that's your kind of cue to be on the lookout for longs. So high, low, when it breaks that high, okay, there's still room to run a trade up into this area here. So this whole structure is the FTR. Within the FTR, again, you're just looking for these untested pockets of liquidity. You can see here that never got tested. Okay, those are the areas at which you should be looking to trade. Again, looking to run price up into this area here. And the reason I pull up this chart is because what you marked out here was this FTR, which is, there's two things to know about that. The first is that, you know, well, this won't be entirely clear until we've covered scale. We'll come onto that in a couple of weeks, but basically you've got within this retrace, you're going to have low time frame FTRs like this one here, okay? But the context here, price is bullish. On higher time frames, it's making higher highs and higher lows, okay? And so you can expect price to be finding support somewhere in this, somewhere in this structure, okay? High, low, price broke that high, retraced, and then carried on up here. So this whole structure is the FTR. And within that structure, you can see you've got untested pocket liquidity there, the area from which price broke out of that with good momentum. So that's why a short here wouldn't necessarily be a good idea, okay? The second reason is that this is what I'd call a local FTR. And what I mean by that is that price made a low, it retraced, put in a high there, and carried on breaking down through this low. But it didn't break down through this pocket of liquidity, okay? Ideally, you know, if you were going to take a short at an FTR like this, you'd want to see this pocket of liquidity broken, okay, for this to break down through that area and then retrace. Is it clear why that's the case? I mean, as I say, it's important not to be too mechanical. You know, what you want to see is for this to be consumed and for there to be some substantial liquidity up in here for you to consider taking a trade down to the next fresh pocket of liquidity down here. So it's a really kind of dynamic process.
During our last meeting, we were discussing the top in gold price from 25th of June on the 1 hour time frame. You told me about a first trade opportunity, but we didn't focus on it. That got me curious, so I went down to the 5-minute time frame to look for it and tried to put your words in the chart. The result was a 6.7R trade that was open for about 4 hours. Okay, I'm pleased to see that you're zooming in and exploring those areas, because that's how you're going to discover the kind of nuances you might otherwise miss. Anyway, this was a section of price action we were discussing. This is gold, and I just started by explaining that when price is up at a pocket of liquidity, which you can't see on this time frame, but which is on the left somewhere and which appears on something like the daily or weekly. Okay, so price is up in that daily liquidity. You don't want to be looking for longs on the hourly or the M30 or whatever this is. You want to be waiting for shorts. Okay, to be watching for the pockets of liquidity which price left behind as it ran up into the level on the lower time frames, and waiting for those to start failing. So I'd be tracking these areas of consolidation and waiting for them to start breaking, and this right here is your first kind of break in market structure. And then price breaks down, it retraces, and it carries on down there. So this is an FTR right here, and it's in here. You should be looking to short the market, expecting continuation. But as you say, that there was an opportunity up at the top here before that FTR even formed, and that is on a test of this high. Okay, price has broken the nearest support there, and you can see at this point that there's still fresh or untested liquidity up at this top. Okay. So this is what you sent me. And of course, this is all in hindsight, but what you've done here is zoomed in on the M5 and found this really nice trade idea, which I think is quite instructive. You can quite clearly see that price is, when price broke down here, this is the structure you want to see break on the M5. That's your FTR. And when price broke down, it never came back and tested this area up here. Okay. That's the area from which price left this FTR with good momentum. So that's your entry, and you're targeting the bottom of this swing there, that fresh pocket of liquidity down at the lows. And I'll go into this in a lot more detail in the webinar on scale. But in this case, what I'd probably do is leave half on and try and run the trade down on the higher time frames, because if we look back at this chart, prices hit daily liquidity. Okay, some structure on the left which is appearing on the higher time frames. It's engulfed this liquidity here on the hourly or the M30. And so I would be expecting price to move down through this low now, okay, to the next pocket of fresh or untested liquidity, which is down here. Okay. Bitcoin, after the flash drop, 13,250 was the small consolidation at the temporary top up here before going back down. That temp top is obviously significant for future reference, but there are two blocks on the left that are also potential resistance. Here and here. Not looking at the lower time frames, where would you say price is most likely to react off? Obviously, we know it ended up reacting to the line, but I'm just asking regardless, just to understand where was the most important area on the higher time frame. So what I'd be looking at is the consolidation at the top here. You can see this was never tested. And this area here. Okay. And neither is more kind of significant, right? We know there's likely to be liquidity at both of these areas, but we don't know how much, and we don't know the strength of the buying until price approaches these levels, right? So all we can do is watch price on approach and take trades at these levels if they offer good risk to reward. Okay, so the answer for me is neither is more significant. Okay, they're both good places to look for trades. The only thing I would say is that the level on the left here, some people call this a breaker or ignored demand. I view these levels as trapped order flow. Okay, so there are people positioned long here who are effectively trapped when price blasts through it. Okay, they don't have time to exit their positions, and so when price comes back to this level, they're trying to get out of those positions. Okay, and if they're long, when they get out of those positions, their exits will be sell limits. Okay, so you expect selling in here when price returns. That's what provides resistance. So I'm more inclined to take trades from these levels on an immediate retest like this one here, as it's more likely that the longs in here have, if price has spent all of this time away from the level, it's more likely that the longs in here have already kind of puked, right? In all of this or in this or in this, and so you're less likely to get a good reaction from levels like this once price has spent a long time away. Okay, especially on the second time back. Yeah, some people call it mitigation block, mitigating their losses, I guess. But that's how I view it. So these areas are good levels to take trades from, on the first time back. If, here, for example, price comes back quite quickly, but if it's spent a long time away like that, and it comes back up here, I'm not taking trades at these levels. These are the areas I'd be looking for trades. Okay, the FTR here and the cap on price. Okay, the extreme.
Okay. The first thing I'd be noticing is that this is an illiquid move. Okay, so depending on context here, let's say we've got some high time frame, ideally fresh or untested pocket of liquidity down at the low here. What I'd be waiting for is for price to start breaking into this illiquid area. Okay, so what you want to see is for FTRs to start forming. So it's not ideal here because this kind of stops in the middle of nowhere, but when that high breaks, price retraces and then carries on up and breaks that high, you can call this an FTR. Okay, and just note where this found support first, at the area from which price broke out of this consolidation, and then slightly lower down in this wider range of consolidation. But the point is that this is now an FTR. You can see that there are areas in this consolidation which were never tested when price ran out from them, and you still have room. Okay, this area of the chart was never traded into, so there's still illiquidity, room for a trade. Okay, when price retraces into this FTR. And where are you looking for trades? This is the area from which price left this FTR with good momentum, and you can see it found support there, and then the extreme, okay, down here. And you can take trades at both of these areas. The way I trade is quite kind of dynamic. So depending on how price approaches, I might take a trade at this top area, and I might take a trade at the area down here. One thing to note, approach is really important, and we'll come into that in a couple of weeks. But the other important thing, which we'll cover in a few weeks' time, is trade management. And for me, if I'm attempting a trade at an area like this, my stop's here, and I'm quickly moving it to break even when price starts pushing up from here. Okay. Especially if it's been tested twice. Because if price finds some residual liquidity up in here, next time it comes down here, it's likely breaking down and through this illiquid area down to the next area of liquidity. Okay. Then when price breaks this high, this whole structure is an FTR. And if I mark out the kind of untested consolidations on the lower time frames in this structure, you can see that there's one in here. Okay. One down here. These are the areas at which price finds support. Is that kind of clear? So you're waiting for that break in market structure which occurs here, identifying the FTR, zooming into that structure to locate pockets at which you expect liquidity to be pooling, and then attempting trades in those areas, looking to run price through this illiquid move here. Okay, because you've got room for a trade. Price is retracing because this move was relatively illiquid. But you've got, as I say, fresh liquidity here and nothing much up here. So that's what I'd call room for a trade.
Right. So I was looking to take this trade yesterday and just marked it out to illustrate my thought process. So price is flagged out on top of this structure, which is your flag limit. It's engulfed here. It's retraced. When it broke this low, which is marked out in red, it's failed to return. It's also engulfed this low here, and there's nothing in the way of price. So my thinking was you've got a clear target there. Okay. So my idea was to take a trade at the FTR and trade it down to the next area of volume. Got liquidity void in there. Just skip forward a bit. Okay, marked out the extreme and then a level above price to protect the stop. This is something I'll go over in the next webinar on approach. So it looks like it's kind of forming a base right underneath my entry, which is not usually something I like to see, but there's no obvious trigger for an influx of order flow. So no clean highs or lows, and price is already kind of in the gap on the left. And so price being in that gap, it hasn't led to a gap slip. Okay, so there's no obvious trigger for a kind of breakout rush here, an influx of order flow, which would be which would make my entry less attractive. Here I'm marking out something else I'll talk about next week, which is compression. So as price moves up, each time it makes a higher high, it's coming down and testing the last area of buy side liquidity. And as it tests it, we can imagine it kind of consuming this liquidity. And so when it comes down through here, we'd expect it to come down quickly, because just like a liquidity void like this, there's no liquidity in here. It's each time it comes down, it's consuming it. Okay, and so buyers are exhausting. Okay, that's what I was anticipating, and I think that's what happened. So didn't quite get the fill.
So this is Bitcoin. Is this an FTR? Circled in blue. Consolidation, then shootout. If so, given we rejected off the FTR and filled the gap in here, this illiquid move created on the way down, does this mean that was the high over here and we can expect downside? This is a great question, and again, the big picture is really important here, so I'll just zoom out for a minute. So there's a lot going on here. The first thing to note is that you've got a significant break in market structure here. Okay, there was a kind of lower time frame break in structure there. Okay, but ideally to short this, you want to see this area go. Okay, that's the high time frame FTR, which we want to see engulfed for price to carry on down. So when that was engulfed, price found buyers down here at this fresh pocket of liquidity. Ran up through this whole area as a result of the illiquid move in here, and two, the nature of the way price traded down here, which I'll come on to in a couple of weeks. That's what I'd call compression. Ran back up through there because this whole area is illiquid. And then what have you got up here? Liquidity in here and fresh liquidity up in here. And down here, this is a relatively illiquid move. Okay, so exactly the kind of scenario where you'd be looking for a short. Okay, price has broken market structure. It's cleared all of the liquidity in here. This is relatively small structure, so you can assume it's been, relatively weak, and that price will push down to the next area of liquidity down here. So yeah, good analysis there. I shorted this up here. Well, I took it on XRP actually, but the same kind of setup was setting up across the majors. Just a beautiful setup. Is that clear? It's a perfect example of price having room to run. Broken market structure. You've got an illiquid move up into this level at which you've still got fresh liquidity. And this is a nice kind of false break setup.
I'm not entirely sure what the question is, but I think you're asking whether or not the quote unquote breaker, which is this here, right, is something you should be trading. And my answer to that is yes. But for me, that breaker, or you might call it ignored demand, it has to have some substance. The reason being that for me, I think this kind of setup works as a result of trapped positioning. In other words, because price kind of ran through this level so quickly, you've got long positioning in here, which needs to get out. These longs are now on the wrong side of the market and therefore looking to get out. So what are they doing when price comes back here? They're selling. In this case, this is also the only logical place to short from on a retrace. It's broken this flag limit. But everything in here is totally compressed. Okay, so if price starts breaking these highs, we've got a void in here. Let's say you want to get short. Well, this is the only real kind of point of reference. So yeah, it's something you can trade, but not something I trade often. But when you get a kind of a level which is ignored like this, it's usually going to be quite responsive when price comes back to it, if prices run through it quickly. Okay. But ideally, I'm looking for something within this leg to enter on. So what I'll usually do is I'll go down to the very low timeframes and find some low timeframe structure in and around this area. Okay. Where does your stop go? If this had more substance, it would go above there. But in this case, I'd want to keep it above the high, because this doesn't kind of really stand out to me. In this move, it's not. It doesn't look particularly significant. What I would look to keep my stop above is something more like that. Okay, it's very clear trap positioning there. In that case, I'd be happy to keep my stop above that kind of ignored base. Ole, I would have looked higher where price left with good momentum. Yeah, there's another kind of pocket in there which you could have looked to trade as well. And although in this case you would have missed that, I prefer to wait for these levels, because even though you miss some trades, the risk reward when you catch them is worth it, right? If you're entering here and your stop above's here, it doesn't matter if you miss a few of these. If you catch this one, the RR is so much better that it makes up for those missed trades. Right, I'm just going to cover a trade I took last week, because I was chatting to one of you about market structure in a meeting, and I realized that the trade I was in kind of contradicted what I'd just been saying. So, and I don't want to contradict myself. So what I was saying, we were looking at this daily chart, and I was saying that on this time frame, I wouldn't usually look to buy a level like this. Okay, given that price is breaking areas of buy side liquidity. Okay, the market structure is bearish, lower low, lower high, right? The point I was trying to make was that the high probability trades are down. Okay, so rather than buying these areas of buy side liquidity on the left, I'd generally be looking to sell on retraces. That being said, within the higher time frame structure, there is opportunity to trade on the lower time frames against the trend. So what happened here is that Let's see. Got a couple of charts here. Okay, this here is this area in here. Okay. Price had hit this fresh liquidity here. See this here? No, never got tested. And it's at the bottom of a daily or weekly FTR. Okay. So it's a higher time frame level, and I'm not expecting that to break immediately on the first test. So remember what I said about jumping the gun earlier. Expect a retrace on the higher time frame. Okay. Don't bank on the immediacy of a move. And this was the response at that level, which I didn't expect, and was quite likely as a result of the news out of China. Anyway, I'll just explain the trade. This is that structure on the lower time frames, and what I was paying attention to was this in here. It's your flag limit. Okay. Beyond that, you've just got this void in price. And I actually shorted this up here and very quickly cut it when the news came out. But as soon as it broke into this illiquid move, okay, it's broken this flag limit. On the lower time frames, you've got an FTR here, high, low, higher, high. That's your retrace. There's nothing in here, okay? So in this scenario, you can kind of jump the gun. You can expect fast continuation. As soon as it broke into that liquid move, I flipped long. The idea being that it's just hit fresh buys on the daily and is now moving into an area in which I don't expect much liquidity, and so it should move through there with relative ease. Anyway, that's the trade. Closed up around 8-7 and made about 23R off that. It was a good day. But I just wanted to make it clear that you can trade lower time frame structure within the higher time frame structure. Okay, and I'll go into that in a lot more detail in the webinar and scale. But the gist of it is this: price doesn't move in a straight line, right? So even though I might be bearish on the higher time frames, it's quite likely that we'll get a retrace, and you can trade that retrace long on the lower time frames if the opportunity presents itself, as long as you've got space, okay, space between the higher time frame levels. And in this case, there was sufficient room to trade the kind of lower time frame structure that emerged here within the higher time frame structure. Does that make sense?
To some extent, the terms flag limit and FTR are kind of interchangeable. But when I talk about flag limits, all I'm referring to are the pockets of liquidity which are constraining whatever range or consolidation price is currently kind of trapped in. And these are most obvious when you get, let's say you get a run up like this, okay. Okay, the flag limit is most obvious when you get a prolonged range like this one at the top here, okay. That's your flag limit. And the limit of this flag range consolidation on the top side will be some structure from the rundown on the left, okay, at which there's still residual liquidity. So those are the limits of this flag. But of course, each of these brief pauses in price on this run up, they also have their own kind of limits on a lower time frame, right? So in here there would have been some small structure holding this up. The same here, okay. And we'll come onto this in more detail when we talk about scale in a couple of weeks' time. But basically, it's important to know that FTRs can also be flag limits in their own right. For example, let's say price breaks down through this low here, okay, pulls back and then continues breaking down. And let's draw that out again. continues breaking down. Okay, so this is now an FTR, low before the high, that low gets broken, price pulls back, it retraces, and it carries on breaking down there. So that's what I'd call an FTR. Okay. But if price then begins to consolidate between these two areas, okay, this FTR here and this FTR from the run up, okay, trap between these two areas, then of course this FTR, that could now be described as a flag limit. Okay, it's the pocket of liquidity which is constraining this range of consolidation. So the important thing to remember is that I've given you these terms so that we've got some kind of structure to work with and with which to look at price. But essentially all we're looking for are areas of liquidity and illiquidity. And with time, hopefully you won't need these terms, because they're just names, and it's important not to be too kind of mechanical about them. And you'll be able to look at price and quickly identify relevant areas without being too, as I say, mechanical about what is and isn't an FTR or a flag limit. Okay, because they're just names, and to some extent they're kind of interchangeable. What's really important is that you become familiar with how to spot liquidity, the consumption of liquidity, and conversely illiquidity on a candlestick chart. And while that may seem like a way off right now, I can guarantee that over the next few weeks you'll become more and more kind of proficient at this as we start to build up this picture of price, and especially as you take time out to practice identifying these structures.